this is your first time on this channel, I want to first start by appreciating you for joining and watching this video. Thanks once again. And most importantly for me is I want to request that if you don't mind, please like, subscribe to this video and share with all your friends so they can also enjoy the amazing gems I'll be dropping in each of my videos. If you have been on this channel before, you've watched any of my past videos and you're back here again, thanks once again, you're the real MVP. So I want to request that you click on the notification bell so you are notified of when I drop a new video and you don't get to miss any of my subsequent videos. So this is the first video on my investment series I'll be talking about. In today's video, I'll be explaining everything ETF investment. I'll be explaining the concept of index funds, ETFs, mutual funds. I'll also be talking about the benefits of investing in ETFs, the factors you need to consider when you're investing in ETFs, and most importantly, I'll be doing a live walkthrough on my favorite app for investments. Alright, without much ado, let's dive deep into it and let's see what's out there for us. So the first thing I would like to explain is what I call the index. Now you may ask, what is index? Alright. Think about it this way. When you were going through school, for instance, there was something called the cumulative GPA, which is the grade point average. Now, it was used to track your performance, your educational performance, your results, and so on. Now, the index is similar to that. The only difference between both is that the index simply measured stocks on the stock exchange and tries to assess the performance of those stocks on the stock exchange using market capitalization, right? The way you check the market prices and so on the stock exchange, it uses some parameters to measure how well those stocks are doing. So that is the index. Now, the index in itself cannot be invested in because it's just simply a measure of performance of those stocks. For instance, we have the S&P 500 index. So the S&P 500 simply measures the performance of 500 publicly listed companies and tries to assess the performance of those companies based on their market capitalization. So what are index funds? Index funds, quite similar to index, just tries to accumulate, I would say replicate the same stocks that the index is measuring, but this time around creates a platform for people to invest into. Now, there are two types of index funds. The first is the mutual funds and the second is the ETFs. ETF stands for exchange traded funds. In today's video, we're going to be talking much more about the ETFs, and I'm just going to provide a general overview of the mutual funds just for your understanding. So what are ETFs? Now, let's make this very simple for everyone. ETF stands for exchange traded funds. Three words make up the ETF. Now, if I try to explain each of these three words, that would help you understand better. Exchange, which means that something that is on the exchange market, the stock exchange. Traded means that it is sold, purchased and sold on the stock exchange market. And fund is just a pool of resources used for different purposes. Now, let's put those three words together and create a concept. Now, the idea of exchange traded funds is simply a pool of funds, which in this case will be stocks that is sold on the stock exchange or bought on the stock exchange. That's the concept of exchange traded fund, simply put. Now, exchange traded funds are established by funds managers, I'll call them, or probably investment managers in this case. What they really do is try to replicate an index or a stock or a set of commodities by pooling resources together, right, to buy those different stocks that they feel are important based on an index that was already pre-existing. So the total stock market ETF, which is also called VTI, that's VTI stands for the symbol or what we call the ticker. What it tries to measure is the total US stock, right? So there's an index that measures the total US stock. So that index is called the CRSP US Total Market Index. Now, it has a number of stock that is tracking or measuring. So this index fund I've talked about, all it just has to do is invest in the same type of stock, or if in this case is a commodity that is being tracked, it invests in the same kind of commodity or stock that those indexes are measuring. The other important thing to know about index fund is that just like any other stock that is traded on the stock exchange market, the index funds are also traded on the stock exchange market. They have the prices fluctuate throughout the day. Now, on the other hand, mutual funds are similar to exchange traded funds in the sense that it's a pool of funds, right? Or it's a pool of stock or pool of commodity stock, whatever the case may be. However, the prices are dependent on the closing price at the end of the day rather than the fluctuating prices throughout the stock exchange day. That's the major difference between mutual funds and ETFs. Okay, now you ask me the question, but why do I need to invest in ETFs? Why do I need to put my funds, my savings or investment into ETFs? Well, I'm going to tell you. The most obvious reason is the diversification. So the key benefit of ETF and the most obvious one is diversification. Diversification is simply when the loss of funds in one investment item is offset by the increase or gain in another investment item, right? Now, in this case, we have so many stock. Okay, let's take a step back. For individual stock, if anything happens to your investment, maybe there's a bad publicity about the business and then the market capitalization drops for that business, your earnings on that business already automatically drops as well. Now think about if you had a pool of resources where the loss of one is offset by the increase of another, then that reduces the overall loss to you or overall loss exposure to you. Let me give a very simple example that will probably help you understand this concept better. Think about seasonal businesses. For instance, an umbrella company, right? So an umbrella making company that sells the most during the rainy season simply because people tend to buy more umbrellas during the rainy season versus an ice cream company that probably sells more during the hot weather, or I would say the hot season, or during summer. Now, think about it. If you were to invest in an umbrella business, right, and you are out of the rainy season, maybe into the dry period where there is no rain, you tend to lose, right? Because the sales for that item would significantly drop. Now, think about if you had invested also in an ice cream company that's selling during the dry and hot period or during the summer, you tend to also make more money during that period versus during the rainy season. Now, if you were to make money at both ends, the loss from one will be offset by the increase in the gains from another. So that's the concept of diversification. So ETF provides that whole concept in a single stock price by diversifying all your investments. So with the pool of funds that we have and weights attached to each of them, losses from an individual stock will not significantly impact your holdings overall. Another benefit of ETF is a low expense ratio. Now, what do I mean by low expense ratio? So think about it. If you are investing $100 in a stock, and the portion of that stock that is used for administrative purposes like management fees and other servicing fees out of your $100 will be regarded as an expense. Now, the expense ratio in this case will be the percentage of that administrative cost or management fees that has been taken to manage your funds divided by the total investment sum. So what that means is that the percentage of your investment that's used to pay administrative fee or other related expenses, that will be the expense portion. So simply put, it's just how much of your investment assets that is used towards administrative expenditures. Very easy. So the expense ratio that will be ideal for you would depend on your financial situation or your risk appetite as a whole or as an individual, right? For me, I like to do about 0.1 and below, except for very special ETFs I know that have always performed so well. For those ones, I don't mind doing up to 0.5 to 0.75% for my expense ratio. So what other benefits are out there for ETFs? The other thing is liquidity. Like I said earlier, you're able to trade on it. The price fluctuates throughout the day, so it's very liquid. You can sell, you can buy, and so on and so forth. The other thing is the cost. It's super cheap. You can actually buy fractional shares, and is ideal for newbies, those that don't understand the concept of investing. If you want to invest in a safe manner, ETF is the way to go because you don't really need to do so much. The funds will typically work on their own. You just need to invest how much you can afford, and it doesn't require you breaking the bank to just invest in them. So there are many types of ETFs today in this present world. We have very common one, which is the active and the passive ETFs. So I already explained what the passive ETF is. Passive ETFs are simply ETFs that are tied to an index which is already measuring certain number of stock, and all they just do is replicate those stocks. So for instance, if we have an S&P 500 that has about 500 to 502 stock, they also have, those funds have to buy the same number of stock, and if the index sells any fund or replaces any fund, they also do the same. So it's usually passive, no special knowledge is required, no effort managing them is required. They just try to replicate. On the other hand, the active ETFs are those that try to outperform the existing index. So for those ones, they are active fund managers. All they do is try to make some very good decisions around your investing your funds. So for those very active ETFs, you tend to find that their expense ratios are higher than the passive ETFs, simply because, of course, you have to pay the funds managers for the effort and the expertise they are bringing to the table. There are also other types of ETFs. We have the bond ETFs, we have the commodity ETFs. Commodities are simply physical stock that are sold on the stock exchange. Then we have the international ETFs, we have sector ETFs. There are just many ETFs out there. So you just need to know what works for you and what aligns with your risk appetite as an individual. Oh, well, I understand. You might just feel that, man, what's this guy saying? He's just saying a whole lot of things. But then I still have the issue of, determining what to invest in, what kind of ETFs, and how do I do it? Well, before we go into all of that, I want to talk about the criteria, what factors you need to consider if you want to effectively invest in the right ETFs. Now, for me, the most important thing I always use when I want to invest in an ETF is I look out for the diversification and the risk. Okay. Now, every ETF always has something called the prospectus, right? In that prospectus, everything you need to know about the ETFs will be clearly narrated there, including historical results about the ETF. Now, why do I look out for diversification? Like I earlier mentioned, I don't want to be exposed to the risk associated with just one stock. So I want to see how well diversified that ETF is. Now, I look out for the number of stocks that make up the ETF. Are those stock or organizations the kind of organizations I believe strongly in, or I believe they have the values I stand for, or they have the possible returns that I'm looking out for? The onus is on you to actually assess those companies and determine if it's fit for you or ideal for your situation. So that's very important. Also, I look out for major holdings in each pool of funds. Now, I'll give an example. The growth ETF has about 241, if my memory serves me right, 241 stock. I look out for the top 10 stock to determine if there are companies I know very much are performing well. I also do some quick financial analysis of their financial statement to know, do these companies have the kind of potentials I'm looking out for, or do they have the growth ability I'm expecting to see in an organization in this 21st century? So once I'm satisfied with that, then I determine if I want to invest in them or not. But like I said, it's very important to know what are the companies that make up the top 10 or top 15 organizations in that pool. Also, another factor to consider, which I believe you definitely agree with me, is the cost and then the returns on your investment. Okay, so what do I mean? The cost is the expense ratio, which I already explained. So if the cost is outweighing the benefit, then of course, from the get-go, it's just not worth it. So I look out for the expense ratio. Does it fall within my acceptable threshold, say 0.1% or 0.01%, whatever the case may be, or whatever threshold you set for yourself? Once I've established it falls within my threshold, then I'm happy on the expense side. Now, in terms of the returns, I look out for historical returns and the year-to-date returns. So year-to-date will be, say, from January to May 2023, for instance, or January to December, or whatever time of the year you are in. So I look out for the performance year to date, and I juxtapose that with the historical performance of 10 years ago. So 10-year performance, 3-year performance, 5-year performance, year-to-date performance. If I see that the returns are amazing, then I go for it. Another factor I also look out for is the dividend possibility or potentials. So if the organization is one that pays dividend and in line with my risk appetite or in line with my investment plan, I'm looking out for organizations that pay dividend, and then I'll consider investing in that ETF. The last but not the least important factor I look out for is the volume that has been traded in the past period. So before you buy an ETF, you want to be sure that it's highly marketable. For instance, we have the VO, or some people call it the VO. It's highly marketable. You want to look at how much volume was sold in the last, say, 6 months, in the last 3 months. Is it worth the while? Once you've considered that to be highly marketable, then it might just be worth your investment. You also want to look out for the volume of the funds. So how much funds do they have? Do they have funds in the $1 billion? Do they have funds in the $1 trillion? I don't think there are so many stocks that have, so many ETFs that have funds in the $1 trillion. But then if the quantity is large, then it just might be worth your while. I'll be telling you how to invest. I'll be walking you through the process of investing in ETFs, which is a very simple and easy process you can do from the comfort of your home. You don't even need to do anything. Just from your laptop, you can do it.